Imagine collecting income from a stock before you even buy it. Then you collect income after you own it. And then you repeat that process over and over again. That is the basic idea behind something called the wheel strategy. It's one of the most popular income generating strategies because it turns a simple cycle into a repeatable process. First, you get paid while waiting to potentially buy a stock you actually like. And then if you end up owning the shares, you get paid while you hold them. And once the shares are sold, the whole process starts again. In this video, I'm going to walk you through exactly how the wheel strategy works, step by step, and show you a real example using Apple so you can see how the entire cycle plays out. I'll also give you a link to a wheel strategy cheat sheet with a trading journal so you can print it out and keep it handy. All right, so let's get started. The very first step in the wheel strategy is to sell a put option. It can be naked or cash secured, it doesn't matter. What's important is that you sell the put at a strike price you'd be comfortable buying the underlying asset at. And the goal for this strategy is for the asset to trade above the strike price at expiration, which is called expiring worthless or out of the money. At that point, you can sell another. If you'd like to know more about selling cash secured puts, check this video up here where I cover the entire process. But statistically, at some point in your trading career, the underlying security will drop below the strike and your put will expire in the money, so you get assigned. But don't panic. You'll now be the proud owner of 100 shares of the underlying. At the strike price, you already said, hey, I'm happy to own it at this price. The good news is assignment is step 2 in the wheel strategy, and now you can sell a covered call on those shares that you just bought, which is step 3. Selling a covered call means selling a call option against those shares to collect income. This time, though, the goal is for the stock to trade below the call option strike at expiration. So you keep your shares and sell another covered call over and over. And so the income cycle continues. If you'd like to know more about selling covered calls, check this video up here where I cover the entire strategy. But like before, statistically, at some point the stock will eventually trade above the call option strike at expiration and you will get assigned, meaning you'll sell 100 of those shares at the strike price. And this is the fourth and final step of the wheel strategy. And guess what? You now have cash again, which you can use to restart the wheel and sell another cash-secured put. Now, to better explain the concept, let's use a real-world example. Let's say you're looking at Apple. At the time of recording, the stock is trading a little below $264. And you'd be happy, let's say, to buy the shares at $250. Now, instead of waiting for the stock to decline, you can sell a $250 strike put on Apple that expires on, say, April 2nd, 30 days from now, at least from the time of recording. You get $3.80 per share or $380 total per contract. Remember, each option is for 100 shares. Now, let's say 30 days goes by and Apple is now trading at $260, still above the strike price. Well, the option expires worthless. Then you can now sell another put on Apple, say for $250 again if you like, again another month out on May 8th. This time, let's say you get $520 for this put. Now, let's fast forward to the expiration date, and what do you know? Apple stock now went down a little bit. It now trades for $245, which means your cash secured put is now in the money, and you'll buy 100 shares of the stock for $250 each. But remember, you were already paid $9 a share already by selling the puts, or $900 total. So your cost basis for these shares is $241 a share. Now, it's important to know your cost basis as we move into the next step. So now you transition to selling a covered call with, say, an expiration of 35 days away, say June 12th. What's important is that now you want to pick a strike that's above your cost basis, which is $241. So let's say you're perfectly fine selling your shares at $255 each. That becomes your call option strike price. The premium on this trade is $3.45 per share, so you'd receive $345 per contract on this trade. Your cost basis, though, it now adjusts lower to $237.55. Hold on to this number. Now, let's say June 12th comes around and Apple is now trading at $254, just below your strike price. The covered call expires worthless, and now you sell another. As long as you sell the covered call with a strike that's above your cost basis, your trade will remain profitable. This time, maybe you decide to set the strike price a little higher at $260 to capture that upward momentum. And you set the expiration to July 17th, and now you receive $5.10 a share or $510 for the trade. Your cost basis now is even lower, $232.45. Fast forward to expiration, and Apple is now trading at $261. It's above the call option strike, so now it's in the money. You'll get assigned, you'll sell your shares at $260 each. That was the call option strike. So let's stop for a moment and have a look at the P&L. Quick math, you sold Apple at $260, your cost was $232.45. That means you have a profit of $27.55 a share, or $2,755 total. Sounds great, right? But if you had bought and held 100 shares of Apple at $263.75 back on March 3rd, and sat on them for the full 150 days, that's 5 solid months, and then sold them on July 17th, you'd actually have a loss of $275, right? $2.75 a share times 100. And that, in a nutshell, is why the wheel strategy can be so powerful. You see how it cycles between cash-secured puts and covered calls, generating income while gradually rotating your capital. The beauty here is in the repetition. Each stage naturally flows into the next, turning your cash into income, your shares into collateral, and your assignments back into cash. The key is to keep track of your cost basis. By the way, I left you a link in the description below for a nice little handout that you can download. It's a cheat sheet that explains the strategy, along with a trading journal to track your cost basis for a trade within the wheel strategy. Of course, markets, they don't move in straight lines. Premiums change with volatility, and while many trades will work out, not every trade will play out this smoothly. Market drops can hurt. If the stock tanks, your short put will most likely result in buying shares at a price that's above the current market price, creating an immediate unrealized loss. On the covered call side, your upside is capped. If the stock rockets above your strike, you miss out on that upside. And that's why the key to the wheel strategy is to always know your cost basis on the stocks that you own. If you can't sell the covered call above your cost basis, then it's usually best to just sit tight and wait until you can. When it comes to the wheel strategy, the key here is discipline. Set strike prices you're comfortable with, manage your cash, and stick to the cycle. The point is, stick to the plan. So whether you're new to options or just looking to add structure to your trading, the wheel provides a framework for you to rely on. Start by selling puts on stocks or ETFs you'd actually want to own, and keep track of your cost basis. Sell the options and let the wheel turn. So that's it for the wheel strategy. Before I go, let me ask you this. Have you used the strategy before, and what were your results? Let me know your thoughts in the comments below. And while you're there, if you found the video helpful, don't forget to like and subscribe because it helps others find the video, it supports the channel, and it makes sure you don't miss out on our next deep dive. Well, that's it for me in this video. Thank you so much for watching, and I'll see you next time.